Well, I think the Community Reinvestment Act did play some portion of a role in it. What it did, of course, is it gave incentives to commercial banks to make mortgage loans to applicants that would not have been granted approval in a purely free market. So in that sense, when people are trying to figure out after the fact why did commercial banks make such reckless loans, surely that's part of the explanation. But I think it's wrong to look at that as the ultimate cause, because we also need to figure out just why was there so much more liquidity in the system in the first place, and why did the bubble get to be so big? That if it had just been more of a minor thing, then the CRA could have explained that, but I don't think it can explain the huge housing bubble that we saw. Well, the FDIC is the federal government's guarantee to depositors that if they put their money into standard commercial banks, their checking account balances are guaranteed up to a certain threshold. So what that does, in effect, is it takes away the responsibility for depositors to care about the solvency of their bank. So when people are putting their money in the bank, so to speak, they don't care what the particular bank is. No one goes and investigates to make sure that a bank makes good lending decisions before they put their deposits with it, because they just know, even if the bank fails, the federal government will bail me out through FDIC. So what that does then, of course, is removes one of the primary market checks on bank lending decisions, and so that's part of the reason why the banking system makes irresponsible decisions. But FDIC, of course, has been in place since the New Deal, and so that doesn't explain why there was a huge housing bubble when we just saw it happen. Well, one of the things economists have said for a long time is that the fact that you can deduct your interest payments for your mortgage, that gives a subsidy to home buyers. So that the idea is if you're going to buy a house versus just renting a place to live, you have an advantage now because the interest component of your mortgage payments you can use that as a tax deduction. So that it's true that funnels people into buying houses who otherwise would have rented, and other things equal, that's going to push up home prices. But again, that would explain why home prices are higher now than they otherwise would be. It doesn't explain why there was a huge bubble that developed, because it's not like that tax wrinkle was introduced in the early 2000s. That has been there the whole time, and it's still there. So that doesn't explain why there was the massive boom and then bust. Well, Fannie Mae and Freddie Mac, of course, were also either outright government agencies in our time, or earlier they were propped up by or created by the federal government, supported by its policies. And again, the function of Fannie Mae and Freddie Mac was to create a broader secondary market in mortgages so that those things would be more liquid than they would have been in a market where the government didn't get involved. And so it too explains somewhat why a housing bubble was able to form. But again, Fannie Mae and Freddie Mac were not created in the early 2000s, so they don't explain why specifically the housing bubble developed when it did. Well, in a free market, the Austrian School of Economics thinks that interest rates serve the function of coordinating production and consumption decisions over time. So basically, if people want to save more for the future, so they defer consumption now, so they don't spend as much on going out to eat and so forth in the present, and they have extra money out of their paychecks that they've saved, and then they lend it through various financial institutions to businesses. So that pushes down interest rates, because now there's a higher supply of savings. Interest rates go down, and in a sense, the low interest rate is like a signal or a green light to entrepreneurs. There's more capital available for them to use productively in their businesses. So that's what role the interest rate plays in a free market. On the other hand, if people are very impatient, they're not willing to save much, well then their supply of loanable funds is very scarce, and the interest rate is really high. So the high interest rate is a signal to businesses that if you're going to borrow money, you better turn it over quickly, because that high interest rate is penalizing you. So a low interest rate goes along with a lot of genuine savings, and a high interest rate goes along with people not being very patient and not saving so much. Well, the way our financial system works right now, when they increase the money supply, specifically when the Federal Reserve buys assets and creates new reserves, and then typically commercial banks increase the amount of loans they make, that increase in the number of dollar bills in the system, if that's the way you want to think about it, that doesn't just hit everybody at the same time. Specifically, that new money comes in through the credit markets. Right? So the new money comes into the economy by being lent into existence primarily. And so it doesn't just raise prices across the board. What happens is, specifically in the beginning, interest rates go way down below where they would have been. And so it doesn't just raise prices, it causes distortions in prices among each other, even right away. And in particular, it makes interest rates lower than they should be. Well, I mean, I've done some empirical work myself at Mises.org and other outlets showing that you can see how Alan Greenspan's policy decisions with the federal funds interest rate, where he took it from 6.5% down to 1% by June of 2003, I mean, that's a pretty substantial drop, and that corresponded with the drop in mortgage rates, and that corresponded with the initial surge up in home prices. So, I mean, the story all fits together. And when he was bringing down interest rates, you do see an increase in the monetary base and some other measures of the money supply. So it's true that you don't see an enormous spike in the growth of the money supply in the beginning, in the early 2000s. But on the other hand, I mean, the story does fit together, and you do see that relationship between falling interest rates and falling mortgage rates and the increase in the money supply growth. And that's right when home prices went up. So I think the basic facts of the story fit together. As far as why don't we have a bubble right now, when under Ben Bernanke, the money supply, of course, has exploded, at least in terms of the monetary base. Well, we're not going to have it in the home sector, again, home price sector, because investors have already been burned once, so they're not going to build up a new bubble in housing prices right away. They will move to something else, and so a lot of people think maybe it's in treasuries or other types of assets. Well, sure. So what happened is, in the fall of 2008, the Fed began implementing a series of extraordinary interventions to arrest the collapse of the financial markets, because panic had broken out after particularly the collapse of Lehman Brothers. And so what was happening is the Fed wanted to inject an enormous amount of reserves into the system. So they were buying assets, and the way the Fed does that is it just writes checks on itself. Okay, so they were writing checks drawn on the Federal Reserve, buying assets from the financial sector with it, and then those people were taking those checks and depositing them in their own banks. So all the commercial banks saw a huge increase in their deposits with the Fed, as it were. So it's like the commercial banks had a checking account with the Fed, and the number representing their balance went way up. Now the problem is that was pushing down the federal funds rate, which is the interest rate that banks charge each other for overnight loans of those reserves. And so at the time, this is again in the fall of 2008, the Fed, it was fighting itself. Like, the one policy was counteracting what it wanted to do with the other policy, because they wanted to inject a bunch of reserves because they had to buy up assets to boost their prices, but yet they didn't want the interest rate on those reserves getting pushed down too low, because their official target was a certain rate, and they were injecting so many new reserves they were pushing down the price of borrowing them. And so that's when the Fed introduced the idea of paying interest on reserves. Okay, so other central banks had the ability to do that, but the Fed only got that authority in, I think it was October of 2008. So now what the Fed could do, and they continue to do to this day, is if a commercial bank keeps its excess reserves parked at the Fed, so instead of making new loans to its customers, it just keeps that money idle, so to speak, sitting at the Fed will pay interest on that, whereas before it would just sit there and do nothing. Now there's an interest rate that the Fed pays. So it's a bit ironic that when everyone's wringing their hands over why aren't commercial banks lending more, one reason is the Fed is literally paying them not to make new loans. So people argue over the impact of that. The interest rate's pretty low. It's about 25 basis points, but nonetheless, the Fed is paying banks to not make new loans right now. Sure. So what fractional reserve banking means is that a commercial bank right now, if you looked at all of the checking account balances of its regular customers, right? So one person looks at his bank balances and says, oh, I have $700 on deposit with that bank. Some other customer has $1,000, some other has $10,000, and so forth. You added up all those numbers and said, how much collectively does this commercial bank's customer base think they have on deposit with that bank? That number is far greater typically than the actual amount of cash that the bank has in the vault or that it has on deposit with the Fed electronically. And so the point is, if everybody showed up on the same day to withdraw his or her money, the bank couldn't pay them off, and there'd be a bank run, and the bank would have to shut down, right? So the reason banks are vulnerable like that is because they only have fractional reserves. In contrast, if they had 100% reserves, that would mean for every dollar that a customer electronically thinks he has on deposit with the bank, that his ATM receipt would show he's got in there, there really would be that amount of cash sitting in the vault in case he showed up and wanted to take it out. So the fractional reserve system is what characterizes our present arrangement, and that's also why when the Fed injects new reserves, typically there's a multiplier effect, because if the Fed creates $1,000 in new money by buying an asset for $1,000, the commercial banks then can make new loans pyramided on top of that, because they only have to have that $1,000 in effect that's sitting in their vault. They can now make maybe $10,000 in new loans. Right, so the Fed's actions get multiplied by a large factor under normal circumstances because of the fractional reserve banking system. Well, I think it's a bad thing that bank runs are possible, right? So I think in an ideal framework, banks would have 100% reserves or close to 100% reserves, so there wouldn't be the possibility of a bank run. But given that we have the current system, I think bank runs are one of the last remaining checks that the public has on irresponsible decisions made by banks. So in other words, when does a bank run happen? It's not just out of the blue for no reason. What happens is rumors start circulating that a particular bank has made a lot of bad loans and it's going to go under, and then people rush to get their money out first. And so that's what happens. And then once some people start doing it, a line develops because everyone wants to get their money out when it looks like a bank is in trouble. So that, of course, is what FDIC was designed to prevent, but I think, again, that's not solving the underlying problem. The FDIC is just sort of trying to get people to not attack weak banks, but the real solution, I think, is to get rid of the FDIC, and banks then would be forced to have closer to 100% reserves. Well, I think that's largely an empirical question, that I think banks, in a free market where the government just enforce contracts, or whatever the agency is that enforces contracts, I think banks would make promises to their customers. If you put a certain amount of money on deposit, and they would say, yeah, we'll have it here for you when you show up. If that's the way it worked, and then people showed up and wanted their money and the bank didn't have it, well, then that bank had violated its contract, and it wouldn't be given any excuses or exemptions the way that, for example, FDR declared a bank holiday in the early 30s because the banks basically got caught with their pants down, right? So that sort of thing obviously wouldn't happen in a genuinely free market. Banks would be held responsible for the contracts they signed. But then it's a separate question to say, okay, in that framework, what would the contracts say? Would the contracts say that we're going to keep your money here and we're going to guarantee you that it's here, sitting in the vault, or would it say we have the right to lend your money out to others, so it's not really your money, and we will just try to make every effort for it to be here? So my prediction is that what we now think of as checking accounts would be 100% reserved or very close to it, but people might not keep much of their wealth in that. They might have more speculative investments. So in practice, it might not change that much, but I think the formal definition of checking accounts would be very close to 100% reserves. Well, the bailouts have been bad for a few reasons. So one thing is just on the face of it, what do? It's money was created out of thin air, basically, in terms of the Federal Reserve buying assets at above market prices. The Fed just wrote checks out of thin air and then purchased assets from institutions, boosting those asset prices and then rescuing those institutions. So it has bad economic consequences. What happened there is the purchasing power of the dollar would have gone up, meaning prices in general were falling. The Fed reversed that trend by injecting all this new money. So what happened is these firms that otherwise would have gone under, they were rescued only by, in a sense, transferring wealth away from everybody else that had dollars, because now the dollar doesn't buy as much. So that's one immediate impact. But then even more long term, it sets a bad precedent, right? That there's what's called moral hazard, that institutions that should have failed, now they're still in operation. And the lesson has been taught that if the next time a boom comes along, go ahead and be reckless and make as much short-term profit as possible, because if it all blows up in your face, either the Fed or the Treasury is going to come along and bail you out anyway. And so it's, the discipline has been removed, that now if you make really reckless decisions that bring short-term profit but might blow up your firm, that's not as severe as it would be under a free market, because now if you're deemed too big to fail, you actually won't suffer the full brunt of your reckless decisions. Well, sure, a lot of people who are genuinely supportive of the idea of the government regulating the financial sector and keeping things honest and checking greedy business people, a lot of people point to the alleged deregulation of the financial sector, and they say that that's partly responsible for the excesses of the housing bubble years. And I suppose there is some truth to that to a very small degree, in the sense that if the government is going to have all these guarantees like FDIC, and then have all the bailouts that were waiting in the wings, and have all the inducements to make reckless lending decisions like the CRA and Fannie and Freddie and so forth, if it's going to have all those systems in place that encourage reckless behavior, well then you can't let the people in the private sector keep all the benefits when the recklessness pays off, and then just pick up the tab when it blows up in their face. That's just, you're asking for disaster, and that's what we got. And that was the system that was in place. I think there's really only two things that can possibly work, two frameworks. One is what the interventionists recommend, which is to have all of the bailouts in place and have all of the subsidies and so forth and the guarantees from the government and the Fed that sort of prevent irresponsible players from bearing the full brunt of their actions, but then also putting on all sorts of regulations to limit their behavior in the first place, to try to keep them from being reckless so that those bailouts don't have to kick in down the road. So that's one approach, which relies on the politicians always being one step ahead of the people in the private sector, right? The regulators have to be one step ahead of the people they're regulating, otherwise that system fails too. So I think that's crazy, and that won't work. It's very naive. In contrast, the system I would propose is to say, get rid of all of the regulation on the front end, let investment decisions be made according to profit and loss and whatever a firm wants to do, but if it blows up in your face, well then tough luck, right? So get rid of all the subsidies and the bailouts after the fact, but then on the front end, let people make whatever lending decisions they want to. Well, what a credit default swap is, it's like an insurance contract, so that if on a financial event. So if you own bonds issued by GM and there's a chance that GM's going to default on those bonds, you can buy a credit default swap, which says in the event of a credit default by GM, this other party will make me whole. And then of course you pay money to that other party for that, to give you that guarantee. So what was happening is a lot of institutions began buying credit default swaps even on assets they didn't own. So it was like you were buying fire insurance on your neighbor's house, that you were going to get paid by the insurance company if your neighbor's house burned down. And so that's what started happening, and the credit default swap market was relatively unregulated, so that's why the interventionists say that this was a problem. The big role that the credit default swap market played in the crisis was that AIG had issued a lot of them. And so that was why AIG got in trouble, and then people say needed to be bailed out. So it wasn't that AIG had bought a lot of bad mortgages. It was that they were on the hook in case those mortgages failed, and in particular, the people they issued those credit default swaps to, they were saying, we think that you're not going to be able to pay us all off, so post a bunch of collateral, and AIG couldn't do it. So that's why AIG actually was in trouble in the fall of 2008. But generally speaking, I think that's sort of a tangent, again, that if it weren't for all of the if it weren't for the housing bubble in the first place, the credit default swaps wouldn't have been an issue. So I think in terms of why did this crisis happen, yes, that was one particular manifestation of the problem, but I don't think that was the big cause, and I certainly don't think if we just had more regulation of credit default swaps, this sort of thing wouldn't happen. Well, yeah, another claim is that certain areas, by putting in place land use restrictions, they made it artificially more expensive to have a housing unit, and so therefore they're pushing up house prices. And so it is true that that can explain why home prices started going up if those land use restrictions kicked in during that period. But if it's the kind of thing where those restrictions were in place as of 1995 and they're still in place now, that doesn't explain why did prices zoom way up in the 2000s and then come crashing down, right? So if the land use restriction legislation changed, then that might explain it. But the fact that one area has a lot of land use restriction, another one didn't, to me doesn't really explain why a bubble might have developed in one or the other. That just would explain why prices in general are higher or lower in one region versus the other. Now, in general, I think speculators perform a very useful role in market economy. What does a speculator do? The credo is to buy low and sell high, or to buy high, or to sell high and cover low if you think something's overpriced. And so if you think about it, if you're a successful speculator, when something is undervalued, you buy it and your action's pushing up the price. And then if something's overvalued, you're selling it and that pushes down the price. So actually speculators, when they are successful, when they make money, they tend to steer prices back towards where they're supposed to be. That they push up prices that are too low and they push down prices that are too high. So speculators actually perform sort of a regulatory function, that they correct prices that are out of whack. Now, it's true, if speculators are wrong, they can feed into a bubble and they can keep pushing up prices. But again, even there, what happens, as long as there's no government intervention, the speculator who gets caught holding the bag, the people that were betting the prices were going to go up right before they crashed, those speculators get killed, right? They lose a ton of money because they were betting the wrong way. So it's true, if speculators make the wrong decisions and bet the wrong way, they're going to lose a bunch of money and push prices the wrong way. But again, there's built-in mechanisms that the market rewards speculators who anticipate correctly the way prices go. And in general, speculators perform a useful function by making prices less volatile than they otherwise would be. Well, that's a good question. That a lot of people are saying the last line of defense, the thing that should have stopped all of this from happening, is that when these big Wall Street firms were buying up mortgages from around the country and slicing and dicing them and putting them into derivative products and then selling them off piecemeal to other investors, the thing that was making that all go through was that the ratings agencies were slapping AAA ratings on some of these products that obviously in retrospect were anything but AAA. And so a lot of people point to the ratings agencies and say they were the ones that, they were the policemen or the regulators, if you will, that were asleep at the switch, and it's their fault. So the question is, why did they do such a bad job? And I think there's lots of different reasons. One thing is just an intellectual error, that the models they were using to evaluate these risks were unrealistic. That, just to give you one example, the computer models they used assumed that the real estate markets across the country in each city were independent of each other, so that the real estate market in San Antonio was different from the one in Boise, Idaho, and so that if house prices dropped suddenly in one market, it would be a different statistical outcome if they dropped a lot in another market. So in their computer models, to get a huge nationwide drop in housing prices across the board, they thought that was an event that would happen one every million years. And so that's why they thought that was so unlikely. So these CDOs and other things that these Wall Street firms were making, the ratings agencies' models thought they were very safe because they were using unrealistic computer models that made these simplifying assumptions. So that's one thing. The other main thing is there's not really that much competition in the ratings agency market because there's government regulations that say, for example, that certain institutions need to hold certain assets of a sufficient safety rating or risk rating, right? So that banks or pension funds might have to have things that are rated AAA, and so forth. And so where do those ratings come from? Well, the government regulations specify which ratings agencies count for those safety ratings. Right? You can't have your Uncle Joe just say, oh, that's a safe bond to satisfy the legal requirement. All right? So the government regulations sort of guarantee that there's a built-in market for the analysis of these ratings agencies. And in particular, after they all screwed up, those agencies aren't going to go out of business and have competitors come in and replace them because, again, those regulations are in place and you need to have analysis and ratings from these agencies that are listed in the legislation. And so that's why they don't just go out of business, even though a lot of them really did horribly screw up during the housing bubble. So I think it's the combination of just human error and then also government regulation preventing competition. Well, people actually don't all agree on the term quantitative easing, but I think a lot of people, what they mean by that is it's a form of a central bank's efforts to stimulate the economy that's not the typical policy of just lowering interest rates. So normally when the central bank wants to stimulate economic growth, it will just cut the benchmark interest rate. But now, in our environment, the interest rates are already down to basically zero, the short-term interest rates that the Fed can control. And so where quantitative easing comes in is to say, now, okay, we're not talking about the level of the interest rate. Now we're going to just focus on how much extra money are we pumping in. And so that's why people will say, oh, that there's like $600 billion in the second round of quantitative easing. So there, we're not focusing on changing interest rates. We're focusing on how much extra money is the Fed injecting. And so the effects are similar to just standard intervention, that the Fed is just creating money out of thin air and pumping it into the financial sector. So if, like me, you don't think that creating money out of thin air actually makes the economy richer, all that does is distorts prices. Prices communicate information, and so when the Fed changes what those prices are, it's just distorting the economy's ability to rationally allocate resources. So it doesn't make us richer. It, in fact, just hinders the adjustment process. Well, during World War I, the Federal Reserve helped the U.S. government pay for the war effort by monetizing the debt, right? So that the Fed would create money to then buy bonds that Uncle Sam issued to pay for the war effort. And so what you saw in the late, like 1918, 1919, 1920, is price inflation in the United States was pretty high. It was over double digits by the end. And so the Federal Reserve wanted to curb that. And so they actually sharply raised interest rates. And then that, in addition to government drastically cutting its budget after the end of World War I, that those two things were very contractionary, and that set in motion a pretty severe depression with a small d in 1920 and lasting into 1921. But the interesting thing is the federal government didn't do any of its standard relief measures, things that nowadays we would call counter-cyclical policy. The federal government, like I said, actually had drastically cut spending. So far from running a big deficit, they actually were shrinking the deficit, and they also didn't do anything to try to prop up prices, and they let workers' wages fall. They stood back and just let that happen. And so even though there was a very severe depression for a year or so, the economy quickly found its bottom and then started resuming rapid growth, which we know as the Roaring Twenties. So I think the lesson from the 1920-21 depression is that you don't need to be afraid of falling prices or falling wages, or what people call deflation. That's fine. The economy can handle that if the government just stands back and lets prices adjust. And it's okay the way you can deal with large price inflation. If the Fed just tightens policy, you can quickly get inflation under control, and that's not going to send the economy into a horrible decade-long slump, that the economy, if left to recover on its own, can very quickly bounce back. Well, obviously there's a lot of different things involved in terms of explaining the Great Depression, but I think the particular issue of why was there a stock market crash in 1929, that had to do with Federal Reserve policy. I think that the Fed was purposely trying to lower interest rates in 1926 to help Great Britain, because Great Britain was having an outflow of gold in the United States, and so the Federal Reserve consciously was trying to lower interest rates, and it engaged in expansionary policy, and that fueled the stock market bubble that we saw in the late 1920s. So the issue of why was there a crash in 1929, from an Austrian perspective, the issue isn't why did all of a sudden the market fall in 1929. Rather, if you look at the prior history, the question is, why did the stock market get pushed way up? Because if you look at the history, you'll see there was clearly a bubble in stock prices. So it was going to pop at some point, and it just happened to do so in 1929. So that's the distortions caused by that Federal Reserve policy of low interest rates and easy money. That explains the boom in the late 20s and why there had to be a corresponding correction. But then in terms of why did it take so long, why was the entire decade of the 30s just awful, that was because Herbert Hoover and then Franklin Roosevelt came along and instituted just a series of unprecedented interventions that were allegedly there to help the economy, but of course, in practice, just prolonged the slump. Well, no, I don't think so. I mean, just on the face of it, the idea that when an economy's on the ropes, the way you encourage prosperity or induce recovery is to take a lot of your able-bodied men and ship them overseas to get shot at, or to take a bunch of resources that could go into automobiles and radios and nylon stockings and instead turn them into bullets and bombs and tanks and then ship them overseas to get used for things that don't intrinsically bring value to anybody. I mean, that's just crazy on the surface of it. War, of course, is very destructive. It's not constructive. Any child can know that war is bad in terms of the economy. So what happened in particular, the reason this myth persists that World War II got the U.S. out of the Depression is that the statistics that a lot of economists use to measure the economy were misleading in that respect. So for one thing is the unemployment rate came way down, but that's not surprising because the government drafted millions of men and shipped them overseas. So yes, you can lower the official unemployment rate if you put them all on ships and get them out of the country. That's obvious. And the other thing is the official GDP statistics showing alleged surges in total national output in the war years. That's because the way those statistics are measured, if the government spends $1 billion on munitions, that naively gets counted as $1 billion of output, even though everybody knows when the government spends money, it's very wasteful. So $1 billion spent by the government is not the same thing as consumers spending $1 billion of their own money on products that they want. And so that's another thing. And one last distortion in the official statistics, the government had price and wage controls in World War II. So the way that real GDP figures would normally be deflated by massive increases in the price level, just by law, that wasn't allowed to happen. The government made it illegal. And so the point is, the official statistics make it look like the U.S. was much wealthier than it really was because they were artificially suppressing the inflation. Well, the first major thing FDR did in 1933 is he severed the pre-existing relationship between the U.S. government and the people, whereby the dollar was tied to gold at the rate of $20.67 an ounce. And so that was freely convertible, so citizens could walk around with gold coins if they wanted, or if people had paper Federal Reserve notes or Treasury certificates, they could go and turn them in and get the equivalent amount of gold back. And so that was what gave the dollar its value, and that investors took that into account when they were making long-term business plans. So FDR in 1933 stopped that. He said no longer is the U.S. bound to redeem paper dollars turned in at the official rate. We're not going to give gold to a private citizen. In fact, he went beyond that and made all of the private citizens turn in their gold under a threat of a large financial and even prison term, financial penalty or prison term. So FDR, that was the first major blow to the gold standard, and the point was he wanted people to be using paper dollars. He didn't want them using gold because they wanted the ability of the Fed to inflate at will, and the gold standard was a check on that. And so they wanted to destroy that, and that's why FDR put those policies into place. Well, so just to fill in the history, so FDR, what he had done is made it so that the average citizen couldn't turn in dollars in exchange for gold. But then in 1934, they revalued gold now at the rate of $35 an ounce. So before then it had been $20.67, and now an ounce of gold was $35. So right there, that was a large devaluation or inflation of the price of gold, if that's the way you want to think of it. But still, the U.S. government would honor that $35 per ounce of gold with other central banks and other governments around the world, and that was codified in the Bretton Woods Agreement. So from the end of World War II up through 1971, the average American citizen couldn't turn in his dollars for gold, but like the Central Bank of France could. They could go to the U.S. government and say, we have a bunch of dollar bills here, give us gold. And so that was that one remaining check that kept the Fed from inflating too quickly, because even though private citizens couldn't do anything about it, at least other central banks could turn in their dollars for gold if they thought the Fed was printing too many dollars. So in 1971, what with all the spending on the war on poverty and the Vietnam War and the deficits that the Treasury was running, even that became too much of a constraint, that other central banks were turning in dollars for gold, and the U.S. government realized that this isn't going to work. We either have to stop so much deficit spending or we have to abandon the peg to gold. And Nixon decided that the thing he was going to give up was the dollars tied to gold. So in 1971, Nixon completely closed the gold window, making the dollar at that point a truly fiat currency where it was backed by nothing. Well, in the Austrian explanation of the business cycle, it's actually the specific mechanism is that credit expands because of fractional reserve banking, and so banks are allowed to create money out of thin air, as it were, and that can still happen under a gold standard. The difference is that the gold standard sort of prevents it from getting to be too severe. All right, so it is true though that process of banks being able to expand their deposits, push down interest rates, and causing a boom, that can still happen under a gold standard, and that's what you find historically did happen in the 1800s in the United States. You can often trace it too to particular calamities like following a war, or when the Second Bank of the United States was shut down. There was a great deflationary trend there at that point. So to see when the very bad recessions, or they might call them panics or crashes, occurred in U.S. history, you can usually tie it to some specific political or military event. But the underlying analysis still is that it was because the money supply expanded because of that fractional reserve credit system, and then when things turned the other way and it contracted, it caused there to be a huge crunch. Well, I used to think it was accepted among economists, but in our recent crisis with all the people talking about it, now I'm not so sure that there's this consensus anymore. But originally, I thought the consensus was that in the 1960s, what was called hydraulic Keynesianism was very naive and adopted the view of what's called the Phillips curve, saying there is a trade-off between inflation and unemployment. So that if you have high unemployment, then the Fed can just pump in new money, and that will cause the economy to start growing because it'll stimulate aggregate demand, and that will reduce the unemployment rate. People will be able to find jobs. But then the trade-off is once the economy, fills the slack, then prices start rising. And so if the Fed pushes too much on the gas, then you're going to have rising prices if it overdoes it. But at least you will have cured the recession. And then going the other way, the idea is if price inflation is too high and the Fed wanted to curb it, it could raise interest rates and stop pumping in so much money, and that would definitely bring prices under control and stamp out price inflation. But then the downside would be you'd have high unemployment. The people would get thrown out of work because of the restriction in aggregate demand. So that was the standard Keynesian framework that policymakers basically had to choose between one of those two evils. And so what the 1970s showed us was that you could have the worst of both worlds. You could have high unemployment and high price inflation at the same time, what they called stagflation. And so that was supposed to have been impossible in the old school Keynesian framework, and that's what led a lot of people to abandon that and adopt something more in lines with the models developed by Milton Friedman and Robert Lucas and some of the Austrians, saying that no, once people took expectations into account, just pumping more money into the economy, at best would just give you a very short-term stimulus, and then workers would adapt to that and then raise their wage demands, and you'd be right back to where you were. Well, right now, I think we are really in uncharted territories, and that's partly why economists are at such odds with each other and they have such wildly different predictions, is that we really have never been here before, in the sense that what Ben Bernanke has done is truly unprecedented. Even during the Great Depression, the Fed did nothing like what we've done now under Ben Bernanke in terms of how fast he increased the monetary base. And so I think that's partly what's going on here. Is we really aren't sure. I still think, though, that it's undeniable that creating money out of thin air, that doesn't make the economy richer. So if people agree that there would have been a huge financial crash in the fall of 2008 because of all those bad lending decisions that had been made during the housing bubble years, Ben Bernanke didn't magically undo all those mistakes by creating $1 trillion and giving it to bankers. Right? Those mistakes were still made, resources had still been misallocated, and all he really did was literally paper over the problem and push it back a few years. So I think that all that's really happened is the day of reckoning has been postponed, and the economy for the last 2 years, or 2 or 3 years at this point, has just been limping along with those problems festering. That what should be happening is people should be saving a lot more to restore the capital stock that was squandered during the housing bubble years, but now interest rates are so low that people aren't saving as much as they should be, right? Because those price signals are being distorted, and so I think all Bernanke is really doing is setting us up for an even bigger crash. And what's worse is, not only is the real economy in trouble, that I think unemployment's going to go up and the stock market's going to crash and so forth, but we're at a very real risk of seriously debasing the dollar, because they've just created so much potential there for more dollars to be created if banks start lending out those reserves. So it's the worst of both worlds. Well, the thing with the U.S. debt situation is it's a bit paradoxical that even as it started under, of course, George W. Bush and then Barack Obama, his administration has just upped the ante, the projections for what's going to happen with the U.S. debt, even over the next 10 years, are just jaw-dropping. And yet interest rates on long-term treasuries are fairly modest. And so a lot of people are just sort of baffled by this, that how can it be is the Treasury is running literally trillion-dollar deficits year after year and projecting them well into the future and showing that the U.S. debt as a share of the economy is going to double in a fairly short time frame, that you would think normally that interest rates should be really high, and yet they're not. And so I think part of what's going on there is, on the one hand, people are very afraid, right? The economy is so bad and the financial markets are in such disarray that as a rush to safety, a lot of people are holding U.S. treasuries just because they don't know what the future is going to bring. And they figure, yeah, even if the dollar does get depreciated, I want to hold these treasuries because I just need something safe. So that's one aspect of it that's sort of keeping yields low on U.S. debt. And the other thing is that the Federal Reserve has been a huge buyer of that debt. And so I think a lot of people are underplaying the significance of that when the Fed comes in periodically and engages in multi-billion-dollar purchases of U.S. debt, we shouldn't be so surprised that the yields on that are being held low because the Fed's waiting in the wings to buy it up. So I think you have those combination of effects that's, again, sort of masking the true reality, and people are sort of have been desensitized to the fact that the government is running trillion-dollar deficits. I mean, that should be shocking, and yet we're used to it now. So it's just all these things are going on, and we've been desensitized. And I think when the crash happens, then we're going to slap our heads and say, what were we thinking? Of course, just like it was obvious that the housing bubble was a bubble after it started tanking, but as it was occurring, a lot of people didn't recognize it for what it was. Well, I think my favorite debt economist is Ludwig von Mises, just because he made so many contributions both in monetary theory, business cycle theory, as well as just general advocacy of free markets, explaining the socialist calculation problem. I mean, he had just done one of his accomplishments. He would have been a great economist, and yet he did a whole range of things, and as well as just being a very systematic thinker and champion of liberty. So, yeah, if I had to pick just one, it would be Ludwig von Mises.